Thank you very much, Mr. Chairman, and welcome again, Mr. Secretary. First, a word about the World Bank, and then I have some questions on the domestic agenda here. You made reference in your testimony to the World Bank's ongoing safeguards review, which will result in revised policies that will govern World Bank lending for years to come. I welcome your statement that you are working hard to ensure that the revised safeguards will strengthen the protection provided by these policies. Having read myself the first draft of the updated safeguards proposed by bank management, I must tell you, you have your work cut out for you. I think the bank's credibility takes a hard hit whenever the bank defends the current draft as a broadening and strengthening of the existing policies. It doesn't strengthen them, and nobody outside the bank believes that they do. I just wanted to share that with you. On the domestic front, as you know, unregulated mortgage credit oftentimes offered with predatory features to vulnerable households without the sophistication to understand the terms was a key cause of the 2008 crisis. Fortunately, the Dodd-Frank Act took key steps to address this problem with the creation of the Consumer Financial Protection Bureau. At the same time, the CFPB has taken many actions to tailor its rulemaking when it comes to small banks and credit unions, and has the authority to amend its regulations if access to credit, especially for our most vulnerable population, become too constrained. Even though the CFPB has been exceptionally reasonable in their approach, last year, the House passed a number of bills to provide additional exemptions to consumer protection, citing lack of credit for low-income borrowers. Can you tell us what data the Treasury has on credit availability since the crisis, and whether you think Congress needs to pursue legislation to create more exemptions from consumer protection rules? We need some help.
Congresswoman Waters, I think that if you look at the current experience in the mortgage market, it's a little bit too hard, actually, for people to get credit in some cases. People with strong credit records, the ability to repay, are having a harder time than they should. It takes the most pristine credit. If you look back to what we were trying to stop after the financial crisis, it was to stop people from getting in over their heads with mortgages they didn't understand, with hidden fees and all kinds of charges. I think that if you look at the way the regulatory agencies have been looking at this, they've been trying to be clear in giving guidance to financial institutions who have, if anything, been tighter in their credit standards than might have been intended. On the other hand, they're not going back and saying we should go back to the kinds of policies that let people get into mortgages they couldn't afford, and to do it in ways that they couldn't understand through all kinds of hidden fees and charges. So I think it's a balance. The regulatory process is very attuned to this. You're seeing discussions of this in both the FHA and the FHFA in terms of the putback risk discussions. My own view is that it is a part of a larger trend in the financial services industry where they're getting more conservative in some ways, in some areas, than was intended. That'll come up in terms of some other questions that I believe will come up this morning. We need to be clear about what we're trying to do and why. I think that it is very important to maintain the regulatory structure so that we don't go back to a system where lenders can get mortgages out there so that people are over their head and highly likely to default. On the other hand, if people are creditworthy, they should have access to credit.
So we are witnessing this inability of our constituents who certainly can afford to get mortgages being shut down and not being given credit by many of our banks, as you have stated. At the same time, we still see actions by banks that are similar to what we thought we were stopping following the 2008 crisis. You know, we had long discussions about everything from no-doc loans to other kinds of exotic products that were being put out there. And it seems that the banks still want to have some kind of a way to continue these efforts, and at the same time, you know, put us all in a bind by shutting down on credit until we basically agree with them. What?
So I actually think if you look at the rules that have come out, the CFPB rules, for example, that I think very clearly make it impossible to issue the kinds of dangerous products that were issued before. It has made our system safer. That's not the problem. The question is for people who are getting mortgages, applying for mortgages that are straightforward English language document mortgages with fees and charges that are clear and costs that they can afford. Are the credit standards so tight that people who are creditworthy not getting credit? We are very much of the view that people who are creditworthy should have access to credit. We are very much opposed to the idea that we should go back to loosening the rules to allow the kinds of mortgages that help create the financial crisis.
So do you believe that what the CFPB has been doing and the approach that they're taking is certainly the right approach, and somehow that's going to help open up credit opportunities? Or what do we do about opening up access to credit?
I think that they have made a lot of important changes that reform some of the basic problems. I think that to the extent that that financial institutions are concerned that they want to be even more constrained than was intended, it is sensible for agencies like FHA and FHFA to be looking at things like putback risk to try and clarify it.
Time of the gentlelady has expired. The Chair now recognizes the gentleman from Michigan, Mr.